Hello, welcome everyone. I'm Jess Spiro, Head of Content here at Simple, and on behalf of our entire team, thank you so much for tuning in today. For those who don't know, Simple is an independent knowledge, data, and access provider to the next generation of family offices. And today, we're tackling the complex world of sustainable wealth, specifically venture philanthropy, impact investing, and ESG, to decipher and make sense of this ever-changing landscape for family offices. Leading our discussion on behalf of Simple is Kyle Macdonald. Kyle is a venture builder at BCG, where after 8 years working in family offices, he designs, builds, and scales new businesses focused on delivering impact for his clients. Joining Kyle today is our panel made up of industry leaders in and around the sustainable investing space. And it is my great pleasure to introduce Amanda Baker, Associate Director of Family Office Solutions at Ethic, an asset manager that specializes in bringing families together to align their investment with impact goals. We've got Damian, Payiatakis, Head of Sustainability and Impact for Barclays. We've got Brune, Ribadeau, Dumas, Head of Impact Solutions at KIMPA, a family office focused on impact. And Lise, Pretorius, Head of Sustainability Analysis at Matter, which provides ethical investing services for large asset holders across a spectrum of requirements. Thank you all so much for being here today. We are so looking forward to hearing what knowledge and insight you have to share. Before I hand over to Kyle, I'd like to remind everyone watching to send in any questions throughout the discussion. We'll keep an eye on the comment section and make sure everything is answered. And that's all from me. Over to you, Kyle.
Thanks, Jess. Always a pleasure. And yeah, really exciting conversation that we're going to be having today as a panel. I think everyone's quite excited about the fact that, yeah, impact is obviously very necessary in the world we live in today. And how to deploy capital in order to enable that is ever more urgent. So yeah, the aim of today's session is really to demystify the impact investment landscape, all the way from venture philanthropy, what is ESG, what can we sort of expect when we begin to think about venture philanthropy and impact investing as a whole. Some of the sort of key agenda items today, we're going to be finding out a little bit more about each of our panelists, what it is that they're driving within their organizations. We're going to be looking at developing a bit of a baseline understanding around the landscape as a whole, understand what the opportunity means for family offices, some of the typical considerations for a family office, and then finally, where's it going? So perhaps I will start off with Brune. It'd be great if you could tell us a little bit about yourself and what it is you're doing over at KIMPA.
Yeah, sure. Thank you, Kyle. Hello, everybody. So I'm Head of Impact Investment at KIMPA. And so KIMPA, we support committed investors who wish to combine positive impact and financial return. So it's basically private individuals and family offices who wish to invest in projects and specific companies with social and environmental impact. We have built for now 3 years a very good deal flow of opportunities, especially impact investment opportunities in Europe, mostly in venture capital, private equity, and real assets. And we want to be a partner for these kind of private investors, in deploying their capital toward solutions, at scale. And we are based in France and in Spain. And for myself, I'm in Paris, in France today.
Brilliant. Thank you. Then perhaps over to Amanda. It'd be great to hear a little bit about the work you're doing at Ethic.
Yeah, absolutely. Thanks again for having me. Ethic is a sustainable asset manager. We specialize in creating passive equity portfolios that are very customized for different investors' financial and sustainability inputs. We cover a really wide range of issues across the environmental, social, and governance-related space. I lead our family office solutions team here, so really working with impact-focused multi-generational families to kind of define and discover the issues that matter most to them, and then putting those into action in their public equity allocation. So we're based here in New York, where I'm joining from today. We manage around $4 billion in assets and work with around 150 different firms today.
Brilliant. Thank you so much. Lise, it'd be great to hear a little bit about the work you're doing at Matter.
Thanks, Kyle. So I lead the sustainability analysis work at Matter. We're a Danish fintech that essentially helps large asset managers, asset owners, any institutional investors, as well as family offices, retail-facing apps with sustainability analysis and reporting. So we help our clients with a range of pre-trade and post-trade services when it comes to understanding sustainability. So on the pre-trade side, that may be defining sustainable investment strategies, helping to identify investments that meet certain sustainability thematic criteria. And then on the post-trade side, a lot on sustainability reporting, meeting regulatory requirements. My role specifically is working with the sustainability definitions in our data and frameworks. As we all know, working in this space, that's a moving target constantly. So really trying to be proactive and pushing the needle on how we define sustainability in terms of multi-stakeholder and regulatory expectations.
Fantastic, exciting and super fast-moving space, which no doubt Damian also has a vast amount of exposure to on a day-to-day basis. Damian, it'd be wonderful to hear what it is you're up to at Barclays.
Sure. So pleasure to be here. Barclays, obviously a universal bank. I sit within the private bank, and since 2016 have been heading up the sustainable and impact investing effort for us. We are working obviously with ultra high net worth individuals, families, family office, charities, and trusts, really focused on the private wealth space, thinking about how do we enable them to protect and grow assets and make a positive contribution to the world. In that sense, my role is partially working and talking to those families and others about how to incorporate sustainability considerations into what they're doing. Also working with the investment teams across the range of investment opportunities we have, from discretionary portfolios to private market offerings and direct investments as well. And lastly, trying to help produce and engage with the wider community around this topic that has, as Lisa said, been growing and evolving over the last few years in a lot of different ways.
Fantastic. So perhaps you would be the best person to sort of kick off our conversation today. So when a family office is beginning to think a little bit about, dipping their toe into the world of impact investing, ESG, etc., it can be quite a complex space. Would you mind kind of giving us a lay of the land, a spectrum of what to expect in the basic terms that they can understand?
Yeah, even as the title has said, right, the different approaches that we talk about. Let's actually not start with labels or umbrella terms, because they're even different region to region, country to country. Regulation and terminology is often different as well. I'd say let's start with the individuals and the family, and let's look at sort of what they want from their investments as a starting point to look at impact, ESG, and responsible investing, ethical investing actually, and venture philanthropy, as we were talking about. I might actually start with ethical. Ethical investing, the way we talk to clients about it, what we're seeing really is a personal view of what is good or bad that predetermines what they want to hold in their portfolio. It's a way to apply a set of values or beliefs. They could be religious, moral, personal beliefs. And the way you implement it is by excluding. We set out a list of sectors and then we exclude, we avoid those. And the motivation is really personal in those cases. So you have to almost be willing to give up potential returns because holding that asset or company is so difficult for you that you don't want to do it. And that's really a personal decision, not an investment one. If I think about responsible investing, the starting point is actually traditional investing. We are now starting to add environmental, social, and governance considerations and data into that process. And we're actually starting to professionalize stewardship, the active ownership, and also the sort of, and also voting, where it's appropriate. But here, what we're really looking at is how well run is a company in those environmental, social, governance bases. How does the company operate? And actually, how does the world have an impact on the company and its potential financial returns? The motivation here is actually really financial, right? We want to make the best investment decision by thinking about the risks that a company is running. Actually, I wrote a very satirical piece about whether or not a drug cartel could get a good ESG score depending upon the framework that you're using. And the third action is impact. So now we're starting to think about more impact considerations, not just what a company, how it operates, but what its goods and services are doing in the world, and the extent to which that solves an environmental or social problem. So here, the intentions of a family or an individual may be both financial and also the societal outcomes that it generates. So here, multiple motivations, different approaches. Most impact investors are seeking to maximize risk-adjusted return. That being said, they can choose not to, and we do see some doing that, which leads us on to that venture philanthropy question as well. Here, our starting point is very clear. We are trying to solve or address a social and environmental problem. In the venture philanthropy context, it's a very specific approach, let's say, where you're looking at a social purpose organization, a charity, or a social enterprise, and trying to help maximize its social impact. You may be tailoring the finance that you're giving it. It could be a loan, it could be a grant, it could be a hybrid instrument in terms of what you're doing. Really, you're thinking now about how do we provide non-financial support and measure the impact as well. And all of these different approaches are options for families to take across their portfolio, or even can be combined within certain circumstances. So hopefully a little starting point to get us going, but shows the breadth of what you can do, but also underlying it, starting to understand, well, what are the motivations, which are important, but also what are the technical aspects of how does that get implemented in an investment portfolio?
Brilliant. Well, I think some key sort of topics there, obviously around this customization, which Amanda, I'll sort of curve onto you on this one. So, typically family offices have varying degrees in how they begin to think about customizing their portfolios. It'd be really fascinating to understand your approach and sort of how you support families with that.
Yeah, absolutely. I think to your point, Damian, there's so many different ways to approach impact and impact investing and the various jargon and terms that exist in the space today. A lot of what we're doing at Ethic is talking more just about, not to add another term, but values-based investing. If we think about values, I mean, every single one of us on this panel, dialed into this call, has different values, have different things that we care about. And that's certainly true of the families that we work with. A lot of and you mentioned this as well, Damian, the scoring methodology is kind of looking at a very high level overview of a company's behaviors, when in reality, when we think about individual companies and industries, for the most part, they have some positive and some varying negative attributes. So a lot of what we're doing is distilling the data that's available today into kind of the raw components, so that the families that we work with can make really transparent decisions around how they want to direct their investments. As I mentioned before, that there's so many different issues that exist when we say sustainability. For some people, that could be climate and pollution and clean water and biodiversity. For somebody else, they could be saying, what sustainability means to me is worker safety and corporate ethics and strong CEO compensation structures that are appropriate in place. And that's going to dictate which companies you invest in really meaningfully. So the approach that we like to take is really rooted in kind of that personalization and transparency off the back of it, is working very closely with families to identify the motivation, identify which issues they would like to address in their life, and then by proxy in their investments, and then providing transparency around, here's the different kinds of company behaviors that we're targeting because you care about women's rights, for example. We're looking at women as managers, flexible working, daycare options, and so many other industries that disproportionately impact women. Here's the different decision making that you can make on top of that, and here's how that will tie into your portfolio. So it's the reason that across all the families that we work with, everybody has different investment portfolios that are hopefully a reflection of what they and their family care most about.
Brilliant. And I guess, Brune, if we think very sort of pragmatically about a family office that's beginning to deploy capital in the world of impact, why is this particularly exciting, and how are you sort of seeing families actively tackle this on a day-to-day basis at the moment?
Yeah, for families, it's a pretty exciting topic. And it's an opportunity to bring the family all together around one specific topic and what they do with their capital. No, but what's interesting is that treating with families and impact investing is that you can address the financial capital, but you're not only addressing the financial capital of families. At KIMPA, we said that we work with 4 kinds of capital of the families. No, the first one is the human capital. We try to align family members to help them invest and undertake together across generations. We have the social capital to measure the effect of the investment in financial terms and in terms of impact on the planet. No, we also have the reputational capital, because the families will communicate about their contribution to meeting the planet's major challenges and maybe inspire other families. And of course, the last one is the financial capital, because they need to design and implement sustainable, profitable and resilient investment strategy, to align with their value, as you said, Amanda. So it's really interesting to treat this topic with family, because it brings all the members of the families, the youngest one, the older one, all together around these specific investment theses that they want to address based on their value.
Perfect. And then I guess around, having these strategies in place, beginning to kind of work towards a bit of a mandate or thesis around this sort of impact. What type of measurable data points potentially should families begin to think about trying to look at? Lisa, over to you.
Yeah, thank you. I think it's a great question, and it's sort of part of why ESG and sustainable investing is at a crossroads at the moment. I mean, we're currently in a place where apparently a third of global assets are under ESG or sustainable into a lot of our global goals. We're way off track to 1.5 degrees, a lot of our social goals, nature loss, etc. Which begs the question, have we really been measuring the things that we're trying to impact in the right way? And the answer is clearly no, not really. We've been failing a bit in that. We've been living in a world of privatized definitions of good sustainability performance, where it's very difficult to understand how is that measured, what are we actually measuring, what is a AA rating of a company, what is a company that gets 2 on a scale of 0 to 10. And so, I mean, essentially what it comes down to is, if we do want to give families, or any other investor for that matter, the opportunity to bring their values to life through their investments and actually make an impact, that requires that we measure and define that thing, whatever it is, whether it's good gender performance or climate performance, in the correct way, to make sure that if we channel more capital into companies that are performing well on that metric, that we actually do end up making the real world outcome that we want to. And what that essentially requires, I mean, we could probably spend a whole hour on this, but in our view at Matter and what we're working on is essentially moving away from privatized definitions of sustainability to definitions that are defined by multi-stakeholder, robust consultation. This is especially important, for example, in dealing with sometimes. And then transparency. So not to just be able to say, oh, well, this company is doing well or poorly, but actually to be able to give all investors and stakeholders the ability to understand exactly how this was measured, and what good and poor performance is in that context. So with data that allows sort of more robust definitions and transparency in how it's measured, I think that that is a prerequisite to allowing impact capital to make the outcome that it wants to.
Brilliant. So yeah, I'll pick up a little bit more about sort of the implementation and adoption of sort of a data-driven approach, but perhaps sort of picking the thread on that sort of black box, when it comes to thinking about impact, and really beginning to think a little bit more about the sort of thesis around why it's a strategic imperative for family offices to begin to embed this into their overall impact strategy. Damian, sort of over to you. What is the advantage of beginning to actually have this as part of your portfolio?
Well, I think in many respects, things that Amanda talked about in terms of values is a very critical piece of it as a starting point. I think we generally see, or I see, 3 reasons why families get involved in this broadly. One is a starting point is the cause. They care very deeply or strongly about a particular issue, be it climate change, gender, nature, etc. And therefore they see their capital being used positively, as well as actually some of the things that Lise said around human capital, social capital, reputational, to be able to make an impact on the world, and that sense of responsibility that comes up around it. I think the second is financial reasons. Partially we are de-risking portfolios or investments by thinking about non-financial issues, thinking about how a company operates in terms of, does it pollute the environment and therefore at risk? Does it use, is it able to recruit the best workers from a social perspective? Or is it well governed in terms of the organizational aspects of it? Help you to decide financially which is a better investment to make. That being said, and sadly the reality is some of the fastest growing sectors globally are the ones that address our social and environmental issues. So from a positive standpoint, in terms of looking at how can we invest on a financial basis and generate returns, people are saying, well, climate change is a massive issue. How do we address it through renewable energy, through off-grid solar, through whatever the issue is? There can be another one. The last one I've sometimes seen actually with global families is where they still have operating businesses, often very interesting, where there is an operating business that's still active, and the family is using family wealth and family capital to de-risk that or to help to enhance it. So there's an Indonesian steel family that is saying, well, we need to green steel and cement, part of the effort to rebuild the new capital there, but we don't know nobody knows how to do that yet. So we are going to invest family capital to help to move some of those solutions forward, and therefore the link to the operating business. I do think there's the last reason sometimes, which is legacy. Thinking about sort of what is our family name known for, and therefore how do we want to appear in the world? A little bit of that reputational capital as well. And interestingly, I was having a conversation today with somebody who's in Asia talking about it's not just the oldest generation who's interested in that anymore, but actually younger generations are saying, what are we going to inherit, but also where do we feel like we want to be leaving the world going forward in terms of our role in transitioning the wealth transfer that's forthcoming as such.
Yeah. So I mean, definitely something I've seen over many years is beginning to sort of take back control a little bit in terms of the family's legacy and its narrative around sort of the legacy it's creating. So very sort of poignant. Never underestimate the sort of human element in fund selection there as well. I guess on that topic, Amanda, it'd be great to pick your brain when family offices are beginning to think about fund selection and working with fund managers. How do you think sort of being more impact centric can kind of support and differentiate an asset manager like yourself?
Yeah, absolutely. I think that it's a very interesting position to be in as a manager in the impact space, because to the points that I think a few of us have made earlier, it's a very personal conversation. Learning from a family across, Lise, you mentioned this, across many generations, especially, everybody's kind of coming in with a different viewpoint, and it's an opportunity, even just from a relationship experience, from a relationship perspective, for the advisors and the investment professionals to really have a deeper connection with the family or the multiple families that they're working with. So for us, I think a huge part of it on the manager side has been really leaning into that role that we can play as not only a manager on the investment side of saying, here's your portfolio and here's what the financial performance looks like, but really leaning into kind of helping firms navigate possibly even just the multi-generational conversation. Or maybe it's on the operational side, maybe it's distilling data and giving talking points around here's how we're supporting this issue. We definitely get questions based on the news cycle as well of how should we be thinking about Russia, Ukraine? How should we be talking to our clients about Roe v. Wade and the overturning and the actions that they can take? So it's actually, I'd say, a big challenge, but also kind of the most exciting part is getting to really be an extension of the family and of their team to help navigate an industry that is as complex and evolving as quickly as sustainability. So we really do like to lean into that to, how can we play a role within this with your family, learn deeply what you care about, and share insights and storytelling as opposed to just an investment experience.
Great. And this perhaps is a bit more of a question for the full panel. And it'd be quite interesting to get a point of view on families that are beginning to explore perhaps, balancing driving impact through, say, investing in a sort of publicly listed ESG or equities versus kind of, slightly more direct investing within the private markets in a slightly more alternative instrument. Are you seeing things like this in your space, Brune? Families looking for slightly different types of investment structures, and how do they begin to kind of balance that within their portfolios?
Yeah, sure. Actually, it's the role of the family office, because a family office with impact functions according to the same missions, that a traditional family office. It must preserve the harmony of the family and protect the assets. So the first part is to protect the asset and allocate depending on the type of risk you're ready to assume. No, so it will approach asset protection not only from a risk-return perspective, but from a risk-return impact perspective. There are three parts in this new way of investing. So, for example, to do so at KIMPA, we've built a methodology that integrates an impact questionnaire, which completes the traditional regulatory process, and we try to understand on the different kind of assets that you can invest in. We try to understand the sustainable development goals that the clients want to address and the sector he wants to see in this portfolio, but also the sector he wants to exclude from the portfolio. And therefore, the family officer will build with and for the clients the best asset allocation, which integrates the impact dimension in addition to the risk return criteria. And to order to better manage this, you need to measure the impact on every type of asset. So we have one tool in order to measure, depending if it's a listed asset, if it's real asset, if it's venture capital, if it's cash, you need to be able to measure the financial return and the impact on each of these asset class, and to consolidate and report to your client.
Yeah, makes complete sense. I guess when families begin kind of thinking a little bit about the typical considerations within the impact space, a big part of classic investing is the due diligence process. I guess, Lisa, when families begin kind of using something like Matter, how could they begin to what should they be looking at when it comes to impact? What type of considerations really are meaningful to them?
Yeah. I think it all comes down to where a family office is, well, any investor is on the spectrum. So we've spoken a lot today about what is driving, whether it's looking for impact, whether it's looking for risk, whether it's just looking for sustainable opportunities. So really understanding, is it just sort of ticking the box on reporting that's needed, or is it really the type of data that's going to allow us to kind of make different investment decisions, identify opportunities, etc. There's a range of considerations, but what we focus on is data to bring essentially strategies and values to life. There are so many reporting requirements now for any investor, really. So if you are looking at climate, it's TCFD, it's net zero, it's SFDR, it's general ESG reports on funds that are claiming to be sustainable. So the first thing is to make life easier, essentially. A lot of family offices typically don't have huge ESG teams with giant data infrastructures that a lot of the larger asset managers have. So the one thing we focus on is basically to allow easy portfolio analysis on a range of different sustainability themes that might be interesting to an asset manager. So if it is around saying, I want to identify companies that have net zero transition plans, that have good climate governance, that are not involved in sort of coal expansions or whatever the criteria are, to easily be able to find the data, to screen portfolios, and to create universes, for example, on that, and to then report on that. And I've kind of mentioned before, but I think in this space, there's really two things that all investors are really facing a lot of scrutiny now. So essentially every client we've spoken to kind of says the thing I stay up at night on is risk of being called out for greenwashing. And that's, I think, that's really our role as a data provider. Real world outcomes, but also to allow clients to really be able to back the claims that they make when creating strategies on this data. So that means it needs to be more intuitive, but also more explainable to regulators and to stakeholders and to the ultimate owners of capital themselves.
Great. Well, perhaps again a question for you, Damian, on how do you typically play the advisory role for families when they're beginning to try and navigate a little bit of that due diligence process? Yeah, over to you.
Well, two things I'd pick up. One is sort of the overall process. Very, very simply, you think about integrating impact into family investing. 3 stages, really. One is thinking and articulating the intentions. So others have talked earlier just about how you can go about doing that, lots of different methodologies as such. But sort of what are you trying to achieve in relation to the portfolio and the family wealth as a starting point, and actually just having those conversations and making that clear as a first stage. Second, then, is looking at sort of the portfolio itself, either existing assets or potential new assets, in order to assess, are the current holdings in line with those or not, and also gives you a starting point for future both investment managers, which we'll come back to, and also sort of potential investment opportunities. And the third piece, as a couple of people have mentioned, is the impact measurement and management, sort of the what is actually occurring in relation to what it is that we would like to have seen in the world, and providing data around that. Importantly, I would note a lot of fund managers today can provide what? Sort of the here's the data that shows either on an ESG basis or an outcomes basis, what's happening in the portfolio. Asking second and third order questions of, so what does that actually mean? And actually now what are you going to do about it? That's where you start to see the difference between fund managers that have high level understanding, but versus those that have really deep understanding in terms of what they're trying to achieve as fund managers. And that links to, I think, a little bit of your question around DD. We do see, and talk about maybe some of the research, but we do see increased concerns around greenwashing in this space as has come up. And also, I think one of the points somebody made about ESG being an easy label for greenwashing, I think it can be used as a label as such, but actually the way that we think about it oftentimes is understanding almost outside in. So when we talk to families or looking at opportunities, the starting point is, what do you want to achieve? That internal perspective of what impact means to you, what sectors and themes are important. Because that's a very clear starting point to exclude things that are not relevant or sufficiently high quality or sufficiently impactful. We all have different levels of degrees of that in terms of what matters to us. But then it's another stage of understanding the investment process and not necessarily what is currently on a pitch pack or a slide deck in terms of what people are doing, and really digging into that investment process and understanding, in Article 8 fund from a European perspective, there's a massive range of what actually could be included in there. And therefore understanding, well, tell me about the investment process and how it works will reduce the risk of ending up with feeling like an investment has been greenwashed, because you understand what the likelihood of a company being in or out would be. And then the last piece, as I said before, is that measurement side around trusting but verifying, sort of bringing the data to life in a way that is meaningful as opposed to just whatever reporting tool a fund manager can use. I think those starting points is the way we look at it, both for ourselves and the platform of who we have, but also when we counsel families in terms of how do you articulate, assess existing, and then look at what outcomes are being generated. How do you keep that cycle going in relation to what you want to achieve?
Yeah, fascinating. I guess, Amanda, we've previously discussed, not today on another call, but we've previously discussed around sort of being issue-centric, right? This thematic investing and sort of aligning a family around something that's meaningful to them. I guess, what's your sort of typical approach when you begin to think about helping families to go on this journey of becoming more confident? So if we think about it from the first step that they've sort of stepped on this journey to beginning to come to a higher level of maturity, how do you support them on that process?
Yeah, absolutely. There's kind of two approaches that we take on our side as it relates to starting that process of what are the different issues that we'd like to look at with your family that matter most to you. So one is for families that are a little bit newer to the conversation, or maybe want to go through the process of kind of discovering this as individuals and then as together. What is your family's, we call it a mission statement. And as you can imagine, across generations, across different viewpoints, there can be some overlap and some not in terms of the different issues that people care about and how they're viewing the world. So we have internal tools that we use. One is our online, we call it the values mapping exercise. That's kind of an internal values exploration that each individual goes through separately. And then we can come in and lead a conversation with multiple stakeholders, whether that's family members or a foundation board, for example, to talk about insights and, here's what you all cared about. Here's what we can come together across these different issues and what that might mean for your investments. The flip side of that is when we're working with a family that's already quite mission driven, typically starting on the philanthropic side, where they're already giving meaningfully. They already have a collection of issues that they're focused on, but maybe not looking at the investment side as aligned with that. So we'll do kind of an internal research exploration with our team of, you've donated to art and science and ocean health in these different ways. How do we take that proactively on our side, do a deep dive on what's the most innovative data that exists in the public markets today on the different issues that you're already thinking about through a philanthropic lens, and then showcase what might that look like in the passive equity space. So it's kind of either starting with the question or starting with a more proactive version of, based on what we've learned, this is what we feel that your family might be focused on. But either way, I think very importantly, it's an entry point to having a conversation with a family about what matters most to them, because a lot of times things come to light in the course of an afternoon, for example, that would maybe yield different results. And the priority is making sure that everybody has kind of a platform to share, to learn, and that we come to an agreement on this kind of codified version of values that's a representative of everybody that was involved in the process.
Great. That makes a lot of sense. I guess when we begin to think about a family, beginning to mature a little bit more along their sort of impact journey and beginning to get a little bit more hungry when it comes to yield, thinking about where is the opportunity to not only, deliver good, but ultimately drive value creation for future generations. Brune, it'd be really interesting to hear about how families are, not necessarily always having to sort of compromise when it comes to ROI.
Yeah, sure. Actually, we see two kinds of investors, two kind of clients at KIMPA. The first one is what we call impact first, which are investors ready to invest in sectors just between philanthropy and investment. So it's usually social topics, and they could have potentially return on investment, which will be lower than traditional market investment. No. But most of our clients at KIMPA are what we call profit for impact investors, and they do not want to do any concession on return on investment just because they do impact. No, it's not because they do impact investing that they expect a lower return on investment. So they expect a market return. And our job here at KIMPA is just to bet on sectors that have a great capacity to scale, tradition with profitable business model, and with a direct correlation between generation of business and impact. No, so we will of course invest in opportunities in very dynamic and innovative sectors such as climate tech, any innovation to reduce CO2 emission or to adapt to climate change, sustainable agriculture, renewable energy production, energy efficiency. All of these sectors are today very dynamic. We have a lot of opportunities in venture capital, in private equity, in this sector, and we can expect actually market returns on these typical sectors. No? So the most important part is to listen to the client, understand what he wants to do, what return on investment he's expecting, and if he doesn't want to do any concession, we need to bet on specific sectors, now on specific asset class. Also, you won't have the same profitability if you bet on venture capital or if you bet on a listed company. So we just need to listen and to find the good opportunities for each kind of client.
Great. So we have a question here, which is, are family offices switching their ESG perspectives from nice to have to it's necessary? Or are they reverting to conventional investments if financial returns are not matching their expectations? So perhaps I can sort of bounce this one over to you, Damian. How are family offices beginning to tackle or perhaps sort of demystify the fact that you need to massively compromise on ESG as a nice to have?
So let me pick that up maybe with a little bit of data to bring it to life. So we, over the last few years, we've supported some research with families and family offices globally. This last year, it was about 150 families. Average net worth was about 730 million, and global survey. Two things just on this question. There's lots of things that come out around the question of financial returns, but also this question of is ESG necessary? We asked across your sort of sustainable or impact investments, have they met or exceeded your expectations? Because to the earlier point, depends on the asset class in terms of both timing and situation and what expectations should be, as opposed to looking at an absolute level. What was interesting is 80% of those respondents said that they had met or exceeded their expectations in terms of the investments. And survey data was from last year, sort of middle of last year. What's more interesting actually was that when we looked at those who were at the first stage of their investment journey in terms of impact investing or sustainable investing versus those who said this is our primary approach to their portfolio, when we looked at the exceed level, it was almost double. So 14% of people said we had exceeded our expectations if it was our first investment, whereas 31% said actually within our impact investments, we're exceeding our expectations, really showing this learning curve that people, get up. And I'm sure Brune will see that from a KIMPA perspective in terms of as you develop the knowledge and experience around this topic, you are going to be more successful at doing it. But the other to this question, I think is really interesting, back to the ESG considerations. And I'm very, very specific about that as the approach that I was talking about before. I think that's where Lise's point in terms of a third of the global assets supposedly are being invested sustainably. Well, most of the time it's incorporating these ESG considerations. We surveyed both sustainable and impact investors, but also traditional investors. And we asked them to separate themselves out first. But then we asked them follow-up questions, even to the traditional investors, about do you use ESG considerations? And what was surprising is even though they did not see themselves as sustainable or impact investors, about 52% of them actually were using ESG considerations in their investment process. This is back to the fundamental point, which is this is about risk-adjusted ESG considerations. Responsible investing is really about risk-adjusted return. I want to have the best set of data available to me to make an investment decision. If I'm a fundamental analyst, or from a data perspective, what Amanda is doing there, we are using that data to inform the investment decision making. And therefore, it's a necessary. It's not a nice to have anymore. And even conventional investments, and you look at the asset management industry, has moved this direction because fundamentally, it's a more informed way of investing, is what it comes down to.
Right. Makes so much sense. Lise, I guess on that sort of risk-adjusted investing, what are the typical kind of data requests that you're thinking a family office CIO might be looking at and sort of requesting something from the likes of Matter?
Yeah. Well, first and foremost, it's just the suite of regulatory requirements that everyone is under at the moment. So things like SFDR, needing to report on a range of environmental and social adverse impacts of different funds. And that's really kind of, as to say, it's not a nice to have anymore. There is no choice. Everyone has to enter the space. Everyone has to get that sort of broad-based data of impact now on the regulatory front. And that's a good level playing field. When we move sort of further into that, it becomes really about everything we've been talking about today. So what is the values and the strategy that we want to bring to life? A lot of what we're seeing now is maybe part of this sustainable fund. It's moving much more into kind of thematic funds, so focusing on things like nature or education or SDGs or specific parts of SDGs, and really trying to say there that we're not only worried about sort of the classic risk-adjusted returns, which Damian mentioned, which is about understanding how things like climate change will affect you, but we really are looking for sort of positive outcomes in the world. We see SDG data as something that is being globally adopted. We see a lot of sort of, there are different taxonomies globally to understand what a sustainable investment means, but SDGs are kind of one level playing field globally that people are using. And then that gets us into the field of kind of, are we making a sustainable sort of contribution with our investments? But then to go one step further, if it's not just about risk or not just about investing in companies that are already sustainable, if officers or investors want to claim actual impact with their investments, they need to kind of prove that the investment that they're giving is doing some additional impact that would not have happened without that investment. So Damian had a good example of providing capital to a steel company to allow it to innovate for green steel. That would not have happened without that money. Hence, it can be called impact. But investing in a company that is already sustainable can be called sustainable, but and so in that sense, it's really just about understanding, are we trying to just understand risks that companies are facing, or are we going through the whole spectrum of trying to claim impact as an office?
Yeah, makes a lot of sense. I guess perhaps then looking at the rise of slightly more thematic investing, how are you seeing the demand change for families now? Amanda, are you seeing a shift in the types of things families are asking for?
Yeah, I think it's super interesting. And this is something that through that kind of online experience that we can actually track over time to get a good idea of what are people asking about, people of different ages, different regions, et cetera, and how that changes through time. Climate and pollution tend to still be some of our top most asked about issues that come up. Second, thematically, tend to be more in the social side, things around women's rights is typically our second most asked about thematic. And then it does depend as well on what's going on in kind of the larger macro landscape throughout 2020. We had a lot of families that were shifting towards more of a racial equity focus. They were basically saying, this wasn't one of our top three when we initially went through this exercise 3 years ago. Throughout what we've all learned throughout the last year, it's now our number one issue, and we need to take a look at what that means for our strategy, for our investments, for our philanthropy, et cetera. And then the last one I'll say that's coming up more recently is just, and Lisa, you mentioned this as well, nature and biodiversity. I think especially when you're looking for kind of consensus across a family, a board, et cetera, nature and biodiversity tend to be ones that almost everybody, feels very strongly about and can agree on is something that's important to focus on and preserve. So that's the last one that I would say is coming up kind of more now than ever. We're seeing that across asset classes as well, that biodiversity is something that's been a really big focus for families this year.
Yeah. So without sort of providing financial advice on the day, we've had a question sort of pop into the chat around, what is the sort of typical percentage of a portfolio that could or should be sort of dedicated to impact? Without sort of arguably saying hopefully all of it. Damian, where are you sort of seeing the balance sort of falling at the moment with families that are slightly more mature in the space?
Yeah, it's a great point. I think there is a movement. There's actually 100% impact portfolios that Tonic is a network of families that they have put out. How do you create 100% impact portfolios across asset classes? I think by and large, it is possible depending upon risk appetite and what you want to do. And certainly within liquid spaces, again, depending upon definitional aspects, you can create those. I think it really depends upon a couple of things. One is, what approach are you going to be taking across, you can apply an ethical exclusion across your entire portfolio 100% very easily. We're going to do this across everything we're doing. To the extent that there are investments that have positive social environmental outcomes, impact outcomes, and are additional by nature, those are probably much more narrow, and you may not be able to do that across all asset classes or all themes, or as Lise said, it ends up being more thematic by sector. I point actually to something, again, I go back to that research, which was really interesting. It's been running it for 9 years. There was some really interesting, we asked people what percentage of the portfolio are they actually, or are they saying is invested sustainably or impactfully? And I went back a couple of years ago, just 2020, it was only about, we asked sort of the bands of percentages, and about 2/3 said under half of their portfolio was invested sustainably or with impact in mind. And 80 to 100%, it was only about 9%, I think it was. Now, this last time around, that's almost flipped, not quite flipped. But now you've got about 20 or 30% of people saying, actually, we are where we feel as though we are 80 to 100% invested for impact. But what's more interesting is looking 5 years out, what percentage, and actually over half said that they were going to end up at that stage. Now, whether or not they're able to do that, how quickly they're going to get there, what opportunities they have, I think is to be seen. But undoubtedly, we've seen this rapid acceleration, both because of the product opportunities, for as much as the regulation can be painful at sometimes, also because of the regulation, because of this greater awareness and interest in the space as well. So I think it's just a question of how quickly the adoption happens, but also to some extent how effectively. I think we're in a bit of a period of backlash, but also around some of the themes and topics, but also in relation to greenwashing and transparency risks as well. But undoubtedly, this is a accelerating space. That being said, I have to say, I think we're still probably at an early adopter stage. Quite frankly, most families have a small proportion, under 0.25% invested in this way. But we can see that flipping very quickly, going forward.
Yeah, makes a lot of sense, I guess. And then Brune, from your side, if we begin to kind of look at the state of play of where the sort of impact space is at the moment, how mature would you say the asset class is?
I think it's getting bigger, but we still have a long road ahead of our work, because basically there was a study saying that if we direct 10% of global investment, global finance towards solutions, that would be enough actually to finance all the energy transition and to meet the 17 Sustainable Development Goals that has formalized the UN. No? And today, or last year, according to the Global Impact Investing Network, we only have 1.1% of the investment which are considered as impact investment, no? With a strict definition of intentionality, additionality, and capacity to measure. So there's only 1.1%, and we need 10%. So there is still a long road, but it's getting bigger. I think a few years ago it was only 0.5%. It started most in the US. Now Europe is getting bigger. Lots of new players every day, new investment funds, and also startup companies. At KIMPA, we measure it at the increase in deal flow of opportunities that we receive. I think 3 years ago, we had maybe only 100 opportunities in our database. And today we have more than 2,000 investment opportunities in impact investing, direct deal, and impact investing funds. So it's getting bigger and faster in Europe.
Great. And I guess perhaps a bit of a bolder question for you, Lise. What is it that gives you optimism and excitement about where this sort of space is going?
Yeah, I think it's I am strangely really encouraged by the whole ESG backlash. It's actually one of the reasons that Matter was born, because of the confusion that we were in at the time with a lot of claims. So the optimism I get is essentially the rigor that's coming into the space now and the transparency. And, we still have a long way to go. We've all touched on a lot of these things, but at least we're putting the ingredients and building blocks in place, like transparency, like regulation, like increased education of wealth owners. Moving towards regulation that says, if we claim a fund is sustainable, you have to be able to prove exactly how you define that and how that's measured, which is a great thing. But then we also have to sort of humble ourselves and say that definition right now is up to every single investor to define themselves. A lot of investors define that very differently, some with stricter requirements, some with looser requirements. Even with the same requirements, different data sets would give you completely different, you use stricter and looser definitions of measuring the same thing. So I think it'll take us a long time to get to a kind of level playing field of knowing that if we're investing in a sustainable thematic Article 8, Article 9 fund, that we're really getting what we are trying to invest in. But my optimism comes from the fact that we really have all the building blocks in place to get there.
Great. I guess, Amanda, on this ESG topic, we obviously know ESG has been politicized a bit, but kind of thinking beyond that, thinking about how family offices can sort of mitigate some of the risks that are sort of happening around this politicization of the topic. Where do you see there to be opportunity for family offices?
Yeah, absolutely. I would definitely echo, Lise, your point about the opportunity, I think, that sits within all of the backlash. There's, of course, the idea and what's happening in the US with the kind of more politicization and ESG getting villainized that I think is, has quite negative impact for the industry and the way that it's being talked about as a whole. But within some of the kind of discourse that was happening around a year ago about lack of transparency and lack of overlap on different data providers, now they're viewing companies and different issues, Lisa, to your point as well, for us also has highlighted, I think, a lot of the different issues of why Ethic was started and why it exists today, to really bring to light how different companies come into contact with various issues in positive and negative ways. You could have companies that have really, really strong, climate goals, et cetera, and really weak internal gender diversity policies, or vice versa, and kind of being able to help families navigate that and bring that to light has been really great. I also think that more than ever, I think that families and investment firms need help navigating this industry. As it kind of as we kind of all walk through this backlash, et cetera, I think more than ever it's been great for us to kind of be able to step in and provide talking points and provide support to these families about exactly what we're doing, the data that goes into our investments, and being able to kind of walk people who their sole focus on the family office side is not impact, but being able to step in and be that impact expert to walk them through this environment is actually something that I think has been a huge positive and a big opportunity for those managers in the space that are exclusively focused on this.
Amazing. Well, yeah, thank you so much for the conversation, the insight today. This is just the tip of the iceberg of the meaningful work that all of you are doing. So Jess, over to you.
Hi, thanks, Kyle. And thank you, Amanda, Damian, Lisa, and Brune for such a fascinating and rich discussion. There were truly some nuggets of wisdom shared here today. And it's clear the conversation around impact and sustainable investing will never really be done. And we're excited to continue diving even deeper into this topic. If you're familiar with Simple, you'll know that this webinar forms part of an ongoing series where we find new ways to shed light and increase transparency into the family office industry. We'll be announcing our next theme very soon, so keep an eye on our socials for more details. If you'd like to learn more about the work we do at Simple, including our high-touch service offering and new products for family offices, don't hesitate to reach out, either via mail or here on the comment section. We love hearing any feedback you've got to share. And lastly, thank you to everyone who tuned in today. They say you are the company you keep, and we're really proud of Simple's engaging and ever-growing community. For anyone who would like to revisit this discussion, the recording will be available to watch right here on our LinkedIn page or via the Simple platform. So once again, a huge thank you to everyone who made today possible. We hope to see you at the next webinar. Bye for now.